Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is Kevin Wadsworth, aka North Star on Twitter. How are you today, Kevin?
Yeah, I'm good, Tom. Thanks for having me back.
Great to have you back. I wanted to get you back because I think it's a good kind of practice to look at the charts here, let's say on a weekly basis from a more technical perspective. So it's really great, and I appreciate having voices like yours and Patrick Karim's, as well as Jordan Roy Byrne and some of our regular guests like Chris as well, so that we can kind of look at things from a purely technical perspective. So why don't we start with the gold-silver ratio?
Yeah, sure. This has been a bit of a giveaway over the last few weeks, really. We reached the sort of historic highs up around 125 on the gold-silver ratio back in March, I think it was, this year. Since then, I've been expecting a very rapid drop down. I mean, those highs of 125 or thereabouts were sort of multi-century highs. I think when you look back, it's hard to go back far enough to find anything quite as high as that. So it's a generational opportunity, really, for anybody wanting to invest in silver. Bit of a no-brainer, as you could say, I suppose. And since that high of 125 or even higher back in March, we've seen the ratio falling. It's all the way down around about 94.5, I think, at the moment, just starting to break down through the long-term support lines. So the move has been pretty swift, and as a result of that, of course, that drop, silver has outperformed gold all the way down.
So how do you build that long-term support line, and what are some of the tools that you use to look at that?
Yeah, it's really just a case of joining the dots. There's nothing particularly complicated about it. So if you look back to the high in sort of summer of 2003, the gold-silver ratio was somewhere around about 82, something like that. And then the next sort of peak was in September 2008. Just join the two with a straight line. And then you can start to see where you might expect or might have expected to see the ratio peak as we get to this current time period. And it would have been somewhere in the sort of 90s, somewhere around about 90, something like that. But the ratio spiked upwards very rapidly in the early part of this year and went straight through the upper resistance levels. We've got a straight line, as I say, joining those peaks in 2003, 2008, and then onwards up to around about 2018. You can join those with a straight line. But as I say, the recent highs have meant that the chart has to be readjusted, so you can now draw a straight line from October 2008 to the peak in July 2019. And that creates a secondary sort of resistance support line. And really all you're doing when you draw these straight lines with sort of peaks in price action is you're creating a sort of a line to cross, if you like. And price action tends to hit that line and it has to make a decision. Is it going to go through that, or the bull's going to carry the price through, or the bear's going to take control and push the price back down again? It's simply a decision point. And clearly earlier on this year, price just skyrocketed straight through that decision point in a vertical spike. And whenever you see a vertical spike in any kind of financial chart, one thing's for sure, either the particular system that you're looking at is going to collapse, or that vertical spike is very quickly going to turn back into a drop where it drops back just about as fast. So there's no sort of voodoo involved here. It's really just decision points for traders and for the algorithms that place the trades as well. Mathematical theory, really. That's kind of all it is.
And just as a reminder to our listeners, one of the better ways to listen to this episode is to watch it on YouTube so that you can maybe follow along with some of the charts that we'll put up. So as you're speaking about spikes, Kevin, well, let's move on to the gold chart. And you're kind of telling us that there's a possible setup for gold to spike above $2,000. So tell us a little bit more about that.
Yeah, I think you've been speaking to Patrick about this as well in recent days. Patrick Karim, and he's all over this as well as many other technical analysts are. If you look at the gold chart, it's formed a very typical arc-shaped sort of base. Some refer to them as cup and handle patterns, where you get a cup shape with a possible handle forming. The arc that sort of defines the price action has taken the price of gold, or brought the price of gold very predictably all the way back to $1,800. And it was very clear as we moved through 2016, 2017, particularly into 2018, where we started to see the right-hand side of this cup being defined. It was very clear that this was the most likely outcome. It was by far and away the most probable outcome. Whenever you're looking at these markets, gold, silver, anything else, nothing's set in stone, but you're looking at probabilities, what's most likely. This was the most likely scenario, and sure enough, we're back here at $1,800. So now that we're here, we have to look back very closely at 2011, where we have a couple of candles on the monthly gold price chart, where the monthly close was around about $1,825. There was a spike that carried price up to over $1,900 during, I think it's August and September of 2011. What that means is that we're at another decision point. So the current gold price has broken through $1,800. It's still trying to make its mind up. Is it going to pull back now, or is it going to spike and then pull back later? Those are really the only two options I see at the moment. We have support down in the sort of 1,600 to 1,650 region. That's sort of dual support from the 20-month moving average and also the bottom support line on the cup, or the arc, or whatever you want to call it. So that's where the support lies. So if we pull back now, that's where we're going, I would have thought. But equally as likely, or probably in my view a little bit more likely, is that we see the price moving upwards a little bit further. And if we get a weekly close above that 1825 level, then that brings the likelihood of a spike, rapid spike upwards into play. Now, what I think is most likely to happen here is that we get a very rapid 2 to 3 week spike that could occur this month, maybe next month, maybe this month, but I don't expect it to last very long. Expect a fairly rapid burnout as we see the price moving to around about 20% above the moving average. And at that point, it's historically typical or historically correct to say that the price is pretty far stretched from the moving average, and you wouldn't expect it to stretch much further. That'll be a high risk point at that stage, and a good place to take profits and expect a fairly large pullback all the way to that 1,600 to 1,650 sort of area.
So once we see that type of correction, Kev, is there something that we can look at, like the MACD, or something to start to indicate support to build back up to move that price higher?
Yeah, different technical traders will have different indicators that they like to look at. I tend to use MACD, the stochastic, and the tricks, not for the triple exponential indicator. And that's not for any reason other than I find those three combined give a good overall view. Now, looking at those three indicators, you can choose to look at them over different time frames. If you sort of look at them over a 1 year time frame, it tends to give a pretty good, clear indication when we're likely to see a turnaround. You zoom out to look at the larger time frame, so you can look back over 5 to 10 years and look at those indicators over a larger time frame. But what you'd expect over those larger time frames is that, for example, the stochastic indicator stays in the sort of high zone, so remaining above 50. So in a bull market, the stochastic indicator tends not to fall below around about 50 or 55. So I would be looking for that particular indicator, just using that as an example, to turn around again at the 50 to 55 level. These long-term indicators sort of remain what you could, I suppose, call overbought for longer periods of time. They tend to remain in the high sort of ranges right the way through the bull market. Don't really see them falling below that level, except perhaps during the 8-year cycle low, as per 2008, for example.
Perfect. Let's move on to the silver chart. And as we saw today, this is being recorded on Monday the 13th. We saw silver move through the $19 level. So let's go through the silver chart and explain to us a little bit about how we're kind of possibly expecting a $21 spike.
Yeah, this is still, the jury's out on this one as well. We're not able to say with any certainty until we get that weekly close, in my view anyway, above $19. At the moment, we're oscillating between, I think today's high was somewhere on spot gold around 1935 or 1937, something like that. And we've dropped back as I speak to around about very close to $19. So there's some resistance in that zone. And when you look at the silver chart, you can see why. All the way back to 2016, there's a zone which I've marked on my charts, which are obviously on Twitter and on your YouTube channel. And that zone sort of has an upper level around about $19. Multiple occasions since 2016, we've seen silver price moving back into this zone and being rejected, pushed back down. Then it moves back up into the zone and gets pushed back down again over and over and over again. So this turbulence zone that we're in at the moment needs to be overcome. It's also a zone of higher volume as well. I think Patrick's charts will show his volume-defined price moves, and where you get this high volume resistance, it needs to be overcome, and then it will be free to move upwards. And the $21 target comes from the previous highs back in 2016, of course. But when you start to sort of measure, well, one particular technique actually for trying to estimate where the silver price might top out on this particular occasion is where we're looking at the gold price over the next few weeks. So if we're looking at $1,900 to $2,000 and the gold to silver ratio dropping somewhere down into the sort of 68 to 70 region, you can then start to work out some of your targets for the silver price. So different techniques give different figures, and you can pick out different resistance levels. My first target is $21. I think for a lot of other people, that's the case as well. Beyond that, I see some resistance in the mid-20s, somewhere around $24 to $26, and then a fairly clear path to somewhere in the low 30s, maybe $31, $32, something like that, with higher targets beyond that. So at the moment, it's going to be a case of just sit tight, wait for this price action to unfold, and then we'll start to be able to piece together where the turning points are going to be in gold and silver over the coming sort of couple of weeks.
So, Kevin, as we speak about these price spikes and looking at the charts for gold and silver, in your opinion, what are the risks and the things to take into account for having a pullback and correction or consolidation for these spot prices?
Yeah, I mean, very typically gold and silver, when it breaks out, can move quite rapidly in a bull market. So you very often get these pretty rapid moves as money moves into the gold and silver market. And silver in particular is quite a small market when you look at the amount of money that's invested in silver miners, for example, compared to, for example, the stock market. It only takes a very tiny percentage move of people's investment portfolio to start causing some very large price spikes, particularly in junior silver miners, as I said. So the risks are that the move is too far, too fast, and you get 20% or so above the supporting moving average. And that's another point, actually. The moving average that is supporting price at any given point in time may be the 20-week moving average, it may be the 20-month moving average, it might be the 1 year moving average. It depends which chart you're looking at, whether it's a short-term chart or a longer view chart. But all you have to do, if you're looking at the trading tools on some of these, for example, Trading View, if you're looking at the moving averages, just find the one that is currently supporting the price over the time period that you're interested in, and then it's a case of just how far stretched you are above that moving average. You look back at historical precedents and work out historically when it is that you need to start being worried. So at the moment, from a historical point of view, we don't need to be too concerned yet that we're only, last time I looked, it was about 10, 12% above the supporting moving averages. So we've got room to run. When I last calculated it with the gold price, it was well above $2,000 before we reached that seriously dangerous point where I would suggest taking profits. It's much the same with silver. So at the moment, we're seeing a response to the March lows, which saw price plunging. Now we're seeing the beach ball bouncing back up through the water, if you like. It's been held down and it's bouncing back up, and we're seeing an opposite reaction.
Perfect. Let's move on to the Bitcoin chart. And if you could, for us, define, Kevin, the stochastic indicator and the RSI, just tell us a little bit about those two tools and how you're using them on this chart.
Yeah, so the stochastic is a momentum indicator. It's based around the closing price of whatever it is that you're looking at. And I've shown on the chart here that the RS stochastic indicator is showing a sort of potential crossover. You've got two lines on the stochastic indicator, and it's sort of a signal line, if you like, that crosses over. I don't like to get sort of too caught up in what these particular indicators mean, because I prefer to look at them as trend lines, whether it's the RSI or whether it's the stochastic indicator. You can overlay them with the price action, and you can very clearly see in this chart, for example, for Bitcoin, two things I'd like to draw your attention to. One is where the two lines cross over. So the stochastic indicator, the blue line and the orange line, where the blue line crosses, and this sounds very simplistic, but it's all that really matters. Where the blue line crosses over the orange line, that's bullish. Okay, and when both those lines are high, above 80, then that's in a very sort of bullish zone where price action tends to be very rapid to the upside. So at the moment, you can see that the blue line is about to cross over the orange line. That's bullish. Second bullish thing is that if that happens, when that happens, those two lines are going to be heading above the 80 level. They're currently around about 70, just over 70. So we've got two very bullish signals there. The fact that they're crossing over and the fact that they're high already, the readings are already high. So that increases the probability and the likelihood that the breakout is going to be in an upward direction. The actual price action itself is forming what looks to me anyway, like a bull flag. The whole thing is contained within a cup chart formation. Or an arc, if you want to call it that. It's a geometrically perfect arc, which I've drawn there. And we have a bull flag forming on the right-hand side of that arc. This happened with gold. It's happened with silver. It's happened on many charts I've looked at where you get this bull flag forming on the right-hand side of the cup pattern. And it's a very bullish setup. The measured move, if you take the length of the flagpole itself, takes you to somewhere approximately $15,000. So that will be my initial sort of target for Bitcoin price on a breakout of that bull flag. Currently, the breakout would be somewhere around about $9,500. So if we see price edging above $9,500, then that's the breakout slowly occurring. First sign for me would be the stochastic indicators crossing over in a bullish fashion.
Perfect. There's lots of exciting things to look forward to there. Finally, let's move on to uranium and Cameco in particular. We've seen lots of news lately that there's more lockdowns in the mines happening. So walk us through this chart and show us what we're seeing.
Yeah, it's interesting how these bull flags and arc patterns sort of present themselves time and time again. It's not fail-safe, of course, with all this technical analysis. Charts do break down sometimes when you're expecting them to break up. But when you see coinciding chart patterns and supporting evidence from the indicators and fundamental reasons within the sector to support your sort of thesis, whether it's for a breakdown or for a breakout, then that just gives you more confidence. So with my sort of career as a weather forecaster, we're always looking for supporting, corroborating evidence. And the more of that evidence that you have, it builds the case for a particular forecast, whether you're forecasting sunshine or whether you're forecasting rain. It's the same with Cameco here. So what we've got is a bull flag. So that in itself would be suggesting price action is going to move upwards. You've also got a geometrically perfect arc, which is supporting the price. So again, that's a bullish predictor. Looking down at the indicators, the stochastic indicator is high at the moment, which is where you want it to be if you want the price to break upwards. It kind of adds, it kind of gives fuel to the likelihood, it adds evidence to the likelihood that the price breakout is going to be upwards. The moving average convergence divergence indicator as well is also showing signs of moving upwards, and it's above zero. When you see that indicator above zero, with the blue line above the orange line, then that is bullish. And that's the situation we find ourselves in at the moment. And added to all of that, the triple exponential, the TRIX indicator, has been falling, which is bearish. It's leveled off and is now moving upwards slightly above the zero line. So that is bullish as long as we remain above zero. So the line has dropped down towards zero and it's now moving upwards. So that's another bullish indicator. Add that to the news that came out of, was it Kazakhstan today, around the extended lockdowns, which will no doubt restrict supply. That's another bullish indicator. So technically and fundamentally, things are looking promising. But as always, it's a case of watching the chart and being ready to respond if we start to see the price breaking down and it reaches your sort of stop levels, which you've set, then take profits and get out of the trade. But at the moment, it's all looking very positive.
Kevin, when you're trying to analyze a chart like this one, and there is corroborating news around, let's say, supply, as we've seen come out of Kazakhstan, do you take that into consideration? And how much do you kind of weight news versus just technical analysis like this?
Okay, well, if you're an expert in uranium and the fundamentals of uranium, the mining difficulties with uranium, and also all of the jurisdictions where the commodity comes from, you know a lot about the driving factors and forces behind the uranium market, then that means a lot more to you as you're analysing the chart. For me, as a technical analyst who isn't an expert on all of that, then I'm basically trading what I see in front of me on the chart. What I've been saying to a lot of my followers lately is trade what you see, not what you think. So you can have a lot of conflicting views and opinions all the time with gold, with silver, with commodities, reasons why uranium is going to go up in price, reasons why it's going to go down. You only need to look at hashtag uranium on Twitter today, and there'll be people arguing very good reasons why the price should go up, and equally people giving reasoned arguments why the price should go down. But that's all very interesting, but the chart will effectively tell you the truth. It'll tell you who's right and who's wrong. As soon as the price breaks down, that the bears are taking control, and as soon as the price breaks upwards, the market's turning bullish. So if you stick to trading the charts and you stick to some fairly straightforward sort of technical analysis and trading rules, then you can't get caught out too much by the discussions and the arguments for and against. Having said all of that, gold, silver, and commodities, the fundamentals behind a commodities bull market developing now are pretty strong. If your thesis is to buy low and sell high, then sure as hell at the moment the uranium market is, if you're buying now, you're buying pretty low in a historical context. So it's searching for value. The uranium market is a place where there's plenty of value to be found at the moment.
Excellent, Kevin. Well, as we wrap up, is there anything else you'd like to add? I think that's a pretty good place to wrap up.
Yeah, all I can say is it's going to be an interesting week. We're going to get our answers, I think, this week with Bitcoin. We're going to get our answers this week with gold, silver, and uranium. If it doesn't resolve this week, then it isn't going to stretch much further beyond that. We're going to get a resolution one way or the other within a number of days. So it's going to be quite a big move one way or the other. As I've said, the pullback could easily be in excess of $200 in gold. If we get that spike, then it could be $200 in the opposite direction. I'm still rating it 60 to 70% for an upwards breakout and 30 to 40% for a downwards correction at the moment. But just remember, if it does break upwards, be ready for that correction because it is coming.
Some sound advice there, Kevin. We can find you at North Star on Twitter and at Gold Tent as well, correct?
Yep, that's the one. That's where I am.
Excellent. Thanks for your time today, Kev.
Thank you very much, Tom. Bye-bye.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?